I track 161 of the best publicly traded companies in the world. I gather historical financial data, assess their fundamentals, as well as research the businesses, and then determine a valuation for every single one of these companies. More recently, 103 of these companies just dropped their latest 10K reports, which provided updated annual financial data to give us a greater clarity and scope towards their current quality as a business. In this video, I'm going to break down several top 10 lists, including return on invested capital, profit margin, growth rate, debt to free cash flow, as well as valuation. And if you stick around to the end, I'll reveal my top 10 companies in this list today. Make sure you stick around and don't forget to like, comment, and subscribe to help the channel grow and help other stock pickers find high quality businesses to add to their watch list. You do not want to miss this video. So to begin, we are first going to look at my number one key metric as an investor that every single one of you should be tracking, and that would be return on invested capital. I have said this time and again, the return on invested capital is simply the net profit divided by the equity plus the debt the company has. This is a key measurement that tracks management's ability to generate reasonable returns with the assets and debt that they take on. If a manager is effective in allocating their capital, they will generate a return on invested capital that is typically above 10%. Charlie Munger, Warren Buffett's right-hand man when it came to investing, always said that return on invested capital is the best long-term indicator of a company's fundamental performance. Because at the end of the day, really, a stock price will appreciate or depreciate based on the fundamentals of that company. And if you are able to generate higher returns using the capital that you have available to you, then that is evidently going to result in better returns over the long run. And Warren always said a return on equity or a return on invested capital above 10% is always the benchmark. So with that, let's break down the top 10 list, see where we're at today after these updated numbers, and then you decide what you think of these companies. So first things first, we're going to start from 10 to 1. At number 10, we have Dollarama with a 41% ROIC. At number 9, we have Texas Pacific Land Trust with 42%. At number 8, we have Medifast with a 43% return on invested capital. We have at number 7, Ulta Beauty with 48%. At number 6, Novo Nordisk with 50%. At number 5, MasterCard with 51%. At number 4, MedPace Holdings with 56%. At number 3, Manhattan Associates with a 61% ROIC. At number 2, Apple with 65%. And at number 1, Fortinet with 70% ROIC. Fortinet is one of the biggest positions in my portfolio today. I capitalized on a time when the market was uncertain, the stock crashed a bit, and I was able to buy at a reasonable price. But even today, after the updated numbers, a 70% return on invested capital is absolutely insane. That means for every $1 of capital that they put towards the business, they're generating about 70 cents in profit from those investments. That is unreal. As I said, 10% is phenomenal. So when you can see that, exceed that, and in this case, a 60% margin from that 10% range, you are in a great standpoint. But it's not just Fortinet. Apple is obviously one of the greatest companies in the world. Warren Buffett had made a huge position early on in the mid 2000s and has since just appreciated in price since then. Now, my criticism of Apple today is that the business is lacking that innovative spirit that ultimately drove these returns. They are struggling to some extent. You do see that from the 4% growth rate here. Now, this is a business that is still a $3.7 trillion company. So you're going to look at this from the surface and say, how the hell is Apple struggling? But the problem is that because of that slowing of growth, as well as an inability to find new products that are going to transcend something like the iPhone, you're finding yourself in a position where today I think Apple's worth just $900 billion. So that is a huge disconnect. You can see that its market cap is trading at a 300% premium at this time. It's just one of those businesses that still is phenomenal in many aspects, but because of that slowing growth, because of that super high valuation, you got to ask yourself, is Apple going to be able to double in the next 10 years? That means it's going to have to hit a $7 trillion market cap. That seems pretty damn tough, especially for such a mature business that has been around for 50 years at this point. So something to consider, especially this is my stance on Apple, but you may think differently. You may think you can generate those returns. And in some ways, it's somewhat of a contradiction given the fact that they have a 65% return on invested capital. So something to keep in mind. Couple other of these businesses, we're seeing Manhattan Associates really phenomenal all around. Again, 61% return on invested capital. It's got a 19% profit margin. Valuation is a little bit steep here. This is only an $8 billion market cap, and it's got an intrinsic value of about $4.8 billion. So a bit of a premium, but still a solid business nonetheless. Obviously, we've talked about MasterCard before. Insane 51% ROIC, but that profit margin is at 45% too. It is a cash generating machine. It is one of the best businesses out there. The only thing from my end is that the company currently has a $442 billion market cap. I think the business is worth about $185 billion. So still trading at a premium, but a phenomenal business nonetheless. Another big fan of Alt Beauty. We will get the updated 10K from them shortly. It sounds like it's going to drop in this first quarter here. So at some point, the data will be updated momentarily and we will get a new reflection. But at the time, it's got a 48% ROIC, a 10% profit margin, 14% growth rate, all phenomenal. This is a market cap of $24 billion, and I think the business is worth about $18 billion. So not extremely overpriced, just a premium of about 35%. So with ROIC off the table, you've seen this top 10 list. Let's move on to profit margin and see where we match up today. So looking at profit margin, straight up, this is a 5-year average. I like to track things over a bit longer of a period because from year to year, you can see fluctuations that may not be truly reflective of what the business is capable of. A 5-year average smooths that out. You get to see the reality at a more conservative and I believe accurate estimation of that profit margin. For those who may not be familiar, the net profit margin is simply the profit you can bring in on top of the revenues that you make as a business. And so it is the money that after all your operating expenses are covered, as well as things like your interest expenses, taxes, all those things, you name it, what do you get to capture as a business after all your dues are paid? And in this case, I love net profit margin. I love a wide berth because you want to be in a position that if the economy does contract, or your industry grows tight for whatever reason, maybe it's going on its own individual recession, you want a company that has a nice cushion that is able to continue generating profits and sustain itself on its own, no matter the conditions. The wider the margin you have, the better berth you have. And you'll notice with net profit margin that it does vary by industry. You're going to find that software companies are able to generate higher net profit margins than a highly industrial business that has a lot of tangible assets. It needs to maintain those, make sure that the equipment is running and functioning properly. And so you'll see that vary. But with that in mind, you will know that there are good businesses throughout, and you just got to find the companies that are able to generate the best profit margins in line with something with return on invested capital as well. So with that, let's go through the top 10 list. And kicking it off at number 10 is Taiwan Semiconductor Manufacturer. So this company has a 41% net profit margin. At number 9 is Bank 7 Corp with 41% as well. At number 8 is Fairfax with a 44%. At number 7 is MasterCard with a 45%. At number 6, East West Bancorp with a 46%. At number 5, Global Ship Lease with a 47% profit margin. At number 4, Visa with a 52% profit margin. At number 3, Nimi Holdings with a 54% margin. At number 2, Euroseas 56%. And number 1, Texas Pacific Land Trust 63% profit margin. So for every dollar of sales they are getting, 63% of that is being captured in profits. That is absolutely insane. I have tracked Texas Pacific Land Trust for some time now. And really, this is kind of the time where it's keying in how impressive this business is. Not only does it have a 63% profit margin, but that 42% ROIC is insane. And it's got 26% growth. It's trading at a little bit of a premium. Market cap's $36 billion. I think the company's worth $29 billion. So a little bit of a gap disconnect, but nothing insane. I think at this price, you can find a reasonable investment, and it's definitely something that you should do more research in to solidify that position. but overall, it is a great business, fundamentally strong, and one of the most impressive businesses on this list. Euroseas, this is a business that I own. I love the shipping company. I think it's a very simple business to understand. You buy ships, you got to maintain them, you got to set contracts and transport goods at a reasonable price and give yourself enough of a gap or a break-even point in order to sustain the business. Euroseas has been operating for more than 140 years. And on top of that, the company only has a $459 million market cap. I think it's worth $3.6 billion. It is a great company. In this last year, 2025, they generated $200 million in free cash flow. And again, they have a $459 million market cap. So let's say you bought the business outright at $459 million. You would generate back your money, your payback, and only start making profit after just 2.5 years. There were so few opportunities out there. And again, a simple business. I'm a big fan of this company, and it is another one that you should definitely research further. As we talked about, Visa, MasterCard, two of the biggest financial platforms in the world. They kind of run the show basically, and that is reflected both in their profit margins as well as their return on invested capital. Now, in this case, Visa gets a slight edge. The only thing, once again, is that both these businesses right now, I think, are trading at a bit of a premium, 121% for Visa, 139% for MasterCard. So something to consider, but these are two of the greatest businesses in the world. Everybody uses Visa, everybody uses MasterCard, whether you are a business, a bank, no matter where in the world, you recognize these two brands, you trust them because they have established themselves as the key infrastructure that ensures that a transaction is accurate for whatever you are buying, whatever good you are transacting. It is likely being driven or supported by Visa or MasterCard. And then to close it off, Taiwan Semiconductor Manufacturer, they generate 76% of the top or most high quality semiconductor chips. NVIDIA uses them, Apple uses them, you name it. Any business that wants the most refined semiconductors, the most transistors, so these 3 nanometer chips, it is coming from TSMC, and it has put them at the pedestal of this AI race. It is a company that, because of what it has accomplished, it has achieved a bit of a premium. It's trading right now at a $1.7 trillion market cap. I think the business is worth about $800 billion. So it's trading at about a 113% premium at this time. Still a phenomenal business to add to your list, research it. And you know what? If you think I'm wrong on my valuation, then maybe you can go make an investment. But that's at your discretion. You got to see what you like about my list, what you don't like. I am open to criticism. I love this stuff and I want to get better. And I hope you do too. So with profit margin out of the way, next we can move to growth rate, see what the fastest growing companies in the world are today. As you can see, we've got some high flyers, but starting with number 10 and going through the list here, we've got at number 10, Afia growing at 35% every year, Houlihan Lokey growing at 36%, Arista Networks at 39%, Shopify at number 7 for 41%, at number 6, Doximity growing at 51%. At number 5, Nvidia growing at 59%. At number 4, Pinduoduo Holdings growing at 64%. Atour Lifestyle Holdings at number 3 growing at 64%. At number 2, CrowdStrike growing at 67%. And at number 1, Oddity Tech growing at 72% annually at this time. One way or another, growth is definitely beneficial. I think you're going to find that these accelerating businesses, it's fantastic, and you hope that they can sustain them. In many cases, you can see that they're a bit smaller business, but you also have massive companies like NVIDIA in this case. And really what you're seeing is that in the past couple of years, as they met that intersect in AI and became the key producer of AI hardware, is they have benefited tremendously. This has led to that acceleration. And one caveat that I have with these fast growing companies is that it is more difficult to sustain these growth rates over the long run, especially as you scale up your business. It's difficult to maintain really anything that's upwards of 30% and beyond. But if you can do that over, say, a 10-year period, at least as you're beginning, or you're in an accelerating market like AI, then you can benefit for the short run. But because I want to have conservative valuations, I want to make sure that I'm using my discretion when it comes to valuing a business, making an attractive investment at the appropriate time, at the right price. I cap their growth rates when it comes to the valuations at 25%. Even though I keep a record of what these true growth rates are. When it comes to the valuation, I cap it at 25% because even then, if you're surpassing 25%, it is phenomenal, but a 25% growth rate when you're applying it to free cash flow is still really solid, and you're going to see these businesses benefit. And you'll note that from that standpoint, I'm highlighting a lot of undervalued stocks here. So that's in direct correlation with the growth rate that I apply. And this is tracked, this growth rate, over a long period of time. So I look at the 9-year average compounded annual growth rate, the 7-year, as well as the 5 and 3, and then apply it to the valuation of the free cash flow. So something to keep in mind, but we're seeing some phenomenal businesses here. As I highlighted, now we're seeing Oddity Tech at number 1. This is a good looking business, 22% ROIC, profit margin of 11%, and then that 72% growth rate is absolutely insane. One little point that I think is a little concerning is their debt to free cash flow is quite substantial at this time. We're seeing a reasonable valuation, but this is something you would want to monitor. Make sure that they're paying down or their free cash flow is accelerating and justifying it, because you just don't want to deal with that much debt all the time. Position yourself for the long run, and debt is going to put you in a tough position if you can't get ahead of it. We're looking at CrowdStrike. I think this is a good company to highlight because even though they're growing at 67%, on a 5-year average, their ROIC and profit margin are still negative. So what that highlights is that the business has experienced losses in the past 5 years. And when I would look at this, I would want to factor in, okay, well, is it improving? And are they positioning themselves to remain profitable for the rest of their lifetime, or at least the foreseeable future? And by that, I mean 10, 20 years. I want to know that this company is able to sustain it, and this isn't just a one-off, or they're accelerating so quickly just simply because of a trend. So something to keep in mind. This is a big business. It's got a $100 billion market cap. I think the company is worth about 64 billion. So in this case, it's trading at about a 57% premium. As I talked about, Nvidia, one of the biggest, most popular businesses in the world, arguably the most popular. They have really burst on the scene. 40% return on invested capital, 37% net profit margin, 59% growth rate. All insane numbers. It is reflective of a company that is deserving of a $1 trillion plus market cap. But in this case, I would argue the business is worth more, about $2 trillion. And today it's trading at $4.2 trillion. So it has a 103% premium. It's just a little bit pricey. And once again, you got to ask yourself, in the next 10 years, is Nvidia going to be able to double its market cap, its valuation, to $8 trillion? It sure is possible, but it's already the biggest business in the world. So you got to keep in mind and also factor in, is this AI race going to continue to sustain itself for 10 years? I think of the dot-com bubble as a good example. There was a time where these internet stocks really benefited tremendously, but then it all came crashing down, and there was a lost decade in the market. Things just didn't sustain. It took nearly 10 years to generate or recuperate your losses if you did invest in the peak in some of these hyped up companies. Nvidia could be one of those businesses, but they have certainly also developed fantastic products that are revolutionizing the game. It's just sometimes the market gets overexcited, a little bit too eager, and pays a bit too much for these stocks. That's my opinion anyways. Could not be true, but that's where I see it at this time. To close it out, we can look at another company, Arista Networks. This is another business that we are invested in. It's got a 27% return on invested capital, 35% profit margin, and 39% growth rate. So they go head to head with Cisco. They provide the networking capabilities of these data centers. The stock actually crashed for a time when fears around AI had sunk in last year. We have benefited well, but even today, at its exceptional growth rate, at its return on invested capital and profit margin, it is still trading at what I believe is a 29% discount at this time. The market cap is $165 billion. I think it's worth $232 billion. So another one of those great companies. It is one of my favorite businesses in the world in terms of what they have accomplished, as well as the quality. It gives me a lot of confidence that they're going to continue to position themselves in this infrastructure and be at the forefront of this technology. And on top of that, they've really started to kick Cisco's butt, which has given them the leading market position in this really highly lucrative market. So another great business to keep track of, one that we're invested in, as I said, and one that you should definitely research and learn more about, and then come to a decision whether you would want to invest in as well. So now, with return on invested capital, net profit margin, as well as the growth rate taken care of, I think the next point to look at is debt to free cash flow. This is a measurement to see how much free cash flow they're generating in relation to the debt and see if it's at a reasonable point in time. And what you'll note is that I actually have found many companies that don't have any debt whatsoever, or at least long-term debt on their balance sheet. This is a great position. There is no risk of bankruptcy if you do not have debt on your balance sheet. So if you can generate positive free cash flow, bring in that capital internally through the cash that you generate, you don't have to go raise outside money, and you also don't have to take on debt. That is the best position. And as you're going to see, there are many, many companies out there that have no debt on their balance sheet. In fact, there are 49 companies out there that I track at least with zero long-term debt. So let's dive into it. Let's see what these businesses are. And kicking off the list, we got Atour Lifestyle Holdings, PDD Holdings, Doximity, Shopify, Arista Networks, Houlihan Lokey, Palomar Holdings, Nextpower, Palantir, Palo Alto Networks, Deckers Outdoor Corp, Monolithic Power Systems, Esquire Financial Holdings, Copart, Texas Pacific Land Trust, Exelixis, Trade Desk, Cactus, Paycom Software, Chipotle, International General Insurance, Moelis, Logitech, Cal-Maine Foods, Powell Industries, IRadimed, Badger Meter, MedPace Holdings, Qualys, Clearfield, Alta Beauty, Manhattan Associates, Erie Indemnity Company, Red Violet, Voodoo Holdings, Nice, Primerica, VIP Shop, Intuitive Surgical, Bank 7 Corp, Taylor Devices, Perion Network, Exelixis, Reddit, Berkshire Hathaway, Robert Half Insurance, USANA, Medifast, Snowflake, and that is the list. 49 companies with zero debt on their balance sheet. There is also another series of companies all below 100% here. Plenty businesses out there that really my benchmark is if you have a debt to free cash flow that is below 100%, you are in a great position, because that essentially means that the free cash flow you could generate in a single year could pay off all your long-term debt. Even the upwards threshold of about 300%, I think, is reasonable. After you get to that range, you just want to consider it. It depends on the industry more than anything. But looking at this list, what you are seeing is many, many businesses out there, nearly 100 businesses in total, all with a debt to free cash flow below 100%. Definitely worth checking out those companies, because I'm a big fan. And once again, you got no risk of bankruptcy if you don't got any debt. So something to keep in mind. Well, now that we've covered the fundamental elements, I think it's worthwhile to dive into the valuation side. First, I'm going to provide a more simple valuation metric. And frankly, I don't use price to earnings quite often, because it is to some extent manipulated by the market. And by manipulation, all I mean is that really the price side of things is based on the market's perception of a business. And as I've highlighted, there are many overvalued businesses. There are also undervalued companies. So it can kind of skew your judgment if you're, say, comparing within one single industry and seeing that, okay, there's this long list of price to earnings ratio, but this business looks more attractive. But again, if this is a business that is struggling, well, then you could end up catching a falling knife rather than making a solid investment. So rather than using that, what I prefer is free cash flow yield, which is kind of similar. It's essentially the free cash flow divided by the company's market cap. And then I also do my own discounted cash flow analysis as well. First, we're going to look at the free cash flow yield, a simple metric. And as I highlighted, it's simply free cash flow divided by market cap. And then we can go on to my true valuation, how I find out what these businesses are worth. So looking at the top 10 list of the stocks with the best free cash flow yields today, we're looking at number 10, we've got Travelers Insurance with a 16% yield. At number 9, RBC 17%. At number 8, Afia 18%. At number 7, Arch Capital 19%. At 6 and 5, we got Voodoo Holdings and International General Insurance, both with 21% yields. At number 4, HCI Group, 22%. At number 3, Cal-Maine Foods with 28%. At number 2, Global Ship Lease, 35%. And at number 1, Euroseas with a 44% yield. Absolutely insane. And these are good businesses. Again, solid, definitely consistently profitable here. You're actually seeing some quite healthy margins. They also have decent growth rates, and the return on invested capitals are reasonable. They are on the lower end a bit compared to some of the companies we've highlighted, but it definitely gives them a good impression. And you're also seeing that translate from the intrinsic value standpoint and that relationship to market cap, that there is further support that these that these stocks are undervalued and definitely worth searching. Now for the final one on my list, this is based on my personal discounted cash flow model, how I assess the valuations of businesses. This gives me a lot greater perspective as to what a business should be worth depending on its fundamentals. I have positioned it in a way that I believe is conservative and reflective of what the business should be trading at. And it also gives me a great scope in relation to what the company's market cap or what it presently is trading for and whether it is undervalued or not. So now looking at the list, let's find out what the top 10 most undervalued businesses in the market today. And starting with Cal-Maine Foods at number 10, it has a 79% discount to its intrinsic value. At number 9, Palomar Holdings, 82%. At number 8, PDD Holdings at 85%. At number 7, International General Insurance, 87%. The same is true for Euroseas. At number 5, Oddity Tech with an 88% discount. At number 4, Kinsale Capital Group, 88%. At number 3, Afia, 91% discount. At number 2, HCI Group, 92%. And at number 1, Global Ship Lease with a 93% discount to its intrinsic value. These are all super cheap stocks. And as I want to highlight again, the quality is there to match. So you want to go out and look at these businesses, go research them, go find out more, see if they truly are worthwhile investments that you want to add to your portfolio. But you can see they're consistently profitable. They have consistently high return on invested capitals and solid growth rates as well. So you're finding a lot of good businesses. I talked about the transportation side. You're still seeing some financial companies between HCI Group and Palomar here, as well as International General. But you can also see that software stocks like PDD Holdings, the great e-commerce company that runs Temu, overall, a lot of cheap stocks, a lot of high quality stocks nonetheless, and some businesses that are definitely worth checking out. And if you've stuck around this far, now it is time to figure out what the top 10 companies as of today are on my list. Let's see what the 1% of the 1% are on a list of over 160 stocks. They all follow the same analytical process. It all is consistent. And this is how I determine where to start looking, what companies to start diving into next, because they show across the board that not only do they have super attractive fundamentals, but they are also trading at a reasonable price that makes it worthwhile as an investor. So looking at it now, the top 10 companies on my list of over 160 businesses are at number 10, Copart. At number 9, Bank 7 Corp. At number 8, Deckers Outdoor Corp. At number 7, Kinsale Capital Group. At number 6, Arista Networks. At number 5, Texas Pacific Land Trust. At number 4, Paycom Software. At number 3, Qualys. At number 2, Doximity. And at number 1, Euroseas. I've already said a lot about Euroseas. I talked about Texas Pacific Land Trust, Arista Networks, but there are also some other businesses that I haven't even dived into fully quite yet. I gathered their financial data, but now this is a great starting point. I can see that across the board, these are all double-digit return on invested capitals, all above 10% easily. The same is true for their profit margins here. They're growing at good clips for the most part. They also, many of them, don't even have debt or very little debt. They all are below or close to a 100% debt to free cash flow yield. And then we're also seeing an attractive valuation. So these are all great businesses, and we've gone through many different companies on this video today. They are all definitely worth checking out. I do a lot of thorough research in terms of gathering the financial data, and the next step to take it to the next level is you got to go dive into the weeds and really understand the businesses. I'm going to go read their press releases, their 10Ks, get anything from their website, news development, any information I can find to have a better understanding of these businesses and that allow me to make a determination that I believe I have a high degree of confidence in. That's what it takes. That's where I'm going next. And if you stick around, I'll start highlighting more of these businesses over time. With that said, thanks for watching. Make sure to like, subscribe, and comment to help the channel grow, and let me know what you think. Which of these companies stood out the most to you? Which of these companies are you a little concerned about? Let me know and tell me in the comments below. But otherwise, thank you, and Equanimity signing off.